I do mostly agree that the level of rates today is not a problem, and we think that any pickup in inflation is likely to be transitory. That said, it's great news that we've got a new month, a new vaccine, and a new issue to focus on. And so markets are starting to move away from COVID and moving towards other issues. And clearly, interest rates and inflation are squarely in the headlights for what investors are focused on today.
And what do you make of the move in technology? Because that really was the source of selling pressure that we saw last week. I mean, I'm looking at names like Amazon, Apple, and Alphabet trading about 15 to 20% off their recent highs.
That's right. Well, any declines in great companies are always discouraging, but we think it's part of a healthy transition and a healthy rotation. Anytime you enter these new eras, things tend to move sideways for a while or be a bit bumpy. Transition and change can be difficult, and we're starting to go through that transition now, starting to look ahead to what the era beyond COVID looks like. And that's causing investors to look into other areas such as small caps or things that have more of a cyclical tilt to them.
Where would you be putting money to work here on the first day of March?
Well, we think the areas that have those tailwinds are still interesting. So with a really strong and improving economy and many sectors going through their own version of cyclicality, we think things like industrials, financials, some of the areas that are disrupted by COVID and are starting to heal, those are the places where we would look. And then further, we'd look to anything that has operating leverage and places who have the potential to improve profit margins, either through productivity gains that they have tackled during COVID or otherwise.
You know, over the weekend, I don't know if you read the Barron's, but there was a big article about how if yields continue to rise, industrials, that's the sector that you want to put money to work because it's one of the sectors that will benefit from a rebound in the economy. And if DC does move forward with an infrastructure bill, I'm wondering if that's an area that you think you'd be sort of putting some money to work here.
That's right. I think that does have a lot of tailwinds. Industrials have a few things going for them, not only an improving economy, but as you mentioned, a changing policy mix and a focus on putting people back to work in America, jobs in America, the American manufacturing renaissance. All of these things lend themselves to an industry like industrials that have those tailwinds behind them.
Speaking of policy, D.C. over the weekend moving forward with the stimulus bill. Now we look to see what the Senate does. But how does that change your sort of consensus on how policies out of Washington could drive this market?
Well, I think in the short term, it's a positive to get that done and get it in the background and help the 10 million people who are out of work. It does create some longer term issues again, and that's why interest rates are squarely in focus. Whether inflation will be caused by any of this, whether rates will start to get out of control, whether the Fed will lose the narrative. We think that's all part of a natural transition. We think ultimately investors will look through that and look to the other side and see a relatively strong economy and rates that have moved higher, but still remain very low by historical standards.
The threat of inflation, Robert, how should we be reading that, and how do you expect that conversation to sort of evolve here in the month of March?
Well, that is certainly one of the issues that's come to the forefront here and is something that's starting to crowd out COVID news a little bit. And I think for good reason. We will see a little bit of modest upward pressure on inflation. We've seen some of it in commodity prices recently. But there are a lot of structural forces keeping inflation down. Some of those are things that aren't going to change, COVID or not, stimulus or not. One thing is that the supply side of this economy is heavily service-based. It's very flexible. It's very resilient. It's very able to change in terms of capacity offered up. You have a relatively slack labor market as well. And you have a lot of other forces going on that are helping to keep a lid on inflationary prices. Those things existed before COVID, and they haven't changed during COVID. So we see a little bit of an increase in inflation, but that'll likely be transitory, and we'll be past that in coming quarters.
All right, so it doesn't seem like you're that concerned about this rise in consumer prices, but yet when you look at the price of oil now back above $65 a barrel, or copper, which is now at a 9-year high, there are certain parts of this market, Robert, that suggest inflation is going to be moving much higher than expected in the near term.
Yeah, that's right. And I think that's consistent with the economy overall, the same way that we've had certain sectors that weren't impacted by COVID at all, some that were absolutely devastated. You see the same types of things across prices for everything. So some prices have remained very stable, very competitive. We have a globally competitive marketplace, easy price comparison. Others, there is a slight tight supply and demand imbalance in some of the commodity areas that you mentioned, and there will be some upward pressure there. But I don't think that's going to be universal across all prices.
Shepard Smith here. Thanks for watching CNBC on YouTube.